The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Hello, a very warm welcome to Squawk Box Europe. I'm Ben Boulos with Ian King, and these are your headlines. Global equities surge on hopes of de-escalation in the Iran conflict, with the three US majors notching their best day since May last year, while the Nikkei and Kospi lead the gains across Asia.
President Trump prepares to address the nation tonight with an important update on Iran after indicating the US is readying a swift exit to the conflict, even without a deal.
We're finishing the job, and I think within maybe 2 weeks, maybe a couple of days longer to do the job.
But the US president hits out at European allies over their refusal to engage in the Middle East conflict, accusing France of blocking airspace access and challenging the UK to source some of its own oil from the Gulf.
Well, certainly a market rally it was on Wall Street at the end of yesterday's session. This is how the three benchmarks closed the day, all of them adding to value and very much in positive territory on the day. In fact, the best daily performance since May last year is the Nasdaq leading the gains, up more than 3.8%, the S&P up just shy of 3%, the Dow adding around 2.5%, and it was a strong showing, buoyed by that fact, or by the optimism around a potential end to the conflict in Iran. This was after President Trump said he expected US military forces will leave Iran in 2 or 3 weeks. And then it was later announced that President Trump will address the nation later on Wednesday. So markets rallying on the hope that there could be an end to the conflict in sight. Let's have a look, though, at the picture for the US markets across the month of March. And well, it tells a very different story. It was a rather torrid month. We saw a sell-off on all of the three main benchmarks for the month, all of them ending between 4.5% and 5% lower. The Dow actually giving up more than 5.3% there, almost 5.4%. So if you look at the month sector by sector, 10 out of 11 sectors ended the month down. Industrials down the most, almost 9%. And energy was the only one to close March actually in positive territory, that basket adding 10% from where it began March. Let's have a look at the picture on the Asian markets, because we saw a rally there. In fact, we're seeing that rally continue. It's the Kospi leading the way. A little earlier, it was up as much as 9%, just down a shade from that, but still a very strong showing from the Korean benchmark, adding 8.75%. The Nikkei also following suit, adding just shy of 5%. The Hang Seng and the Shanghai Composite also on the front foot in Wednesday trading. Again, a degree of optimism, I think it's fair to say, around those talks that President Trump was saying that he's willing to sort of leave Iran in 2 to 3 weeks. He says we leave because there's no reason for us to do this, yet at the same time rebuking some of America's NATO allies for what he sees as their failure to step up and help reopen the Strait of Hormuz. So let's see how much that risk on sentiment is being felt in the European futures. And it is carrying across. Look at that. A stronger open being called across the main benchmarks, including the Pan-European Stocks 50, once trading gets underway for the Wednesday session in just under an hour from now. As usual, we will bring you the market open right here on Squawk Box Europe. Ian.
Thanks, Ben. US President Donald Trump has said Washington could end its military campaign in Iran within 2 to 3 weeks, dismissing the idea a negotiated deal is needed to end the war. Attention is now on the president's address to the nation tonight, where he will deliver an important update on the conflict, according to the White House. Well, speaking in the Oval Office, the president outlined the reasoning behind his time frame.
I think we're 2 or 3 weeks in. We're negotiating with them right now. They've been, again, we have had regime change. Now, regime change was not one of the things I had as a goal. I had one goal. They will have no nuclear weapon. And that goal has been attained. They will not have nuclear weapons. But we're finishing the job. And I think within maybe 2 weeks, maybe a couple of days longer to do the job.
Meanwhile, the Wall Street Journal has reported the UAE wants to force open the Strait of Hormuz and is willing to join any effort to do so. That's a stark shift in the Gulf states' stance following a month of Iranian attacks. Dan joins us now. Dan, some really important words in that report that the UAE is willing to join any effort to do so. That's not necessarily saying that it would lead any effort to do so, but significant nonetheless.
That's exactly right, Ben, and we are seeking clarity on the UAE position now, but it is reported that the UAE is preparing to join this military coalition to reopen the Strait of Hormuz by force, and of course markets are watching this very closely. Arab officials tell the Wall Street Journal that Abu Dhabi is lobbying for a UN Security Council resolution to authorize this action, and a vote is expected as soon as Thursday. Of course, if this is correct, the move would make the UAE the first Gulf state to become an active combatant in this war. But of course, the Gulf views on how it should end are divided here. Saudi Arabia, Kuwait and Bahrain want Washington to press ahead in a similar vein as the UAE. One senior official telling the Journal they want Trump to, quote, finish the job. But of course, Qatar and Oman want diplomacy. Either way, it seems as if the view from the Gulf here from all sides is that they are concerned that Israel may not stop bombing even if Washington does. And then meanwhile, on the diplomatic front as well, China and Pakistan have proposed this 5-point peace plan calling for an immediate ceasefire and the reopening of the strait. It is hard to see this getting off the ground for now, given the US is firmly in control of the narrative. And of course, for the markets, the strait remains the only theatre that matters. We see 20% of global oil still shut out, and analysts also warning that if the Strait of Hormuz stays shut for another 6 weeks or so, we could see oil prices hitting $200 a barrel. So what we're seeing right now is markets really rallying on hopes of a Trump exit, but it doesn't necessarily mean that the strait is going to automatically reopen when the bombs stop flying as well. So the situation here on the ground pretty volatile at the moment as we seek further clarity on the UAE position and of course exactly what President Trump is going to say in this primetime address, which will take place at 5 a.m. Gulf time tomorrow morning. Will he signal a diplomatic off-ramp here or a military escalation? You get the sense that this could go either way.
Dan, obviously Trump said overnight that he felt the US had achieved its objectives in that Iran would no longer have a nuclear weapon. What's been the reaction to that in the region? Because we haven't actually had conclusive proof that they still don't have these uranium enrichment facilities.
Well, that's exactly right. And the president did hint to this through his news conference that he held overnight, suggesting that that uranium was hard to get to because he's holding on to the idea that those nuclear sites were obliterated last summer during the initial US Israeli campaign. But of course, exactly what Iran has remains to be seen at this point. There's no real transparency or even clarity coming out of the country, not only because of the nationwide internet outage, but also authorities on the ground there, including the leadership, really staying tight-lipped about what their own signals and intentions are. What we do know, though, is that the IRGC has threatened to strike some 18 major American companies across the Gulf today, including the likes of Apple and Google, Microsoft and Tesla, accusing them of providing AI and surveillance technology used to target Iranian leaders. So we are likely to see the threats from Iran continue to ratchet up. Whether or not those threats actually turn into real kinetic missile and drone attempts remains to be seen at this point. But of course, it doesn't seem as if the narrative on either side is cooling off in any way at this point.
OK, Dan, thank you very much for bringing us up to date on the latest, as ever. Dan Murphy there for us in Dubai. And we will have full coverage of President Trump's address to the nation right here on CNBC. You can catch that speech, which is starting 2 a.m. London time tomorrow. Meanwhile, Washington's European allies have once again drawn the ire of President Donald Trump over their lack of support for the war in Iran, with the US leader singling out the UK and France in particular. In two separate posts on Truth Social, Trump said countries reliant on the Strait of Hormuz should, quote, go get your own oil, also accusing France of preventing US warplanes from flying over its territory.
Well, according to our next guest, the conflict in Iran is creating a perfect storm for the petrodollar. Malika Sachdeva is the FX strategist at the Deutsche Bank Research Institute. Malika, lovely to see you this morning. Are you saying then that the dollar is going to be displaced as a petro currency?
There's a lot at stake for the dollar in the long term out of this conflict. The Middle East is strategically very important to the dollar's role as the world's reserve currency. The reason that the world saves in dollars is because the world pays in dollars. And the reason the world pays in dollars is because global trade is largely invoiced in dollars. And that has a lot to do with the fact that oil is priced in dollars. Because oil is so crucial to global manufacturing and to global transport, if oil is priced in dollars, then the rest of the global value chain gets dollarized. And so the big question that we have to ask ourselves is, well, why is oil priced in dollars? And to answer that, we have to go back to the petrodollar arrangement in 1974, where Saudi Arabia agreed to price oil in dollars in exchange for US security guarantees. And what this conflict is doing is it's drawing attention to the US security umbrella over the Gulf. And if dollar dominance is built on petrodollar dominance, which is built on the US security umbrella, then there could be a lot at stake from this conflict for the dollar.
But you think actually the foundation of the dollar as the petrodollar was actually being undermined even before this conflict?
In some sense, a lot of Middle East oil has been being sold to Asia over the last many years. So 85% of Middle East oil is sold to Asia. Saudi Arabia sells 4 times as much oil to China now as it does to the US. But that oil has continued to be priced in dollars. And a lot of that has to do with the fact that there is this US security umbrella over the Gulf region. So while a lot of the trade and economic relationships were starting to change, it's really the security architecture that the US was offering that was keeping the dollar dominant in oil pricing.
I mean, we have seen attempts in the past to try and displace the dollar. I mean, there have been attempts to price contracts in the yuan, even in the ruble in the recent past. What makes it different this time?
So, I mean, China has been, trying to internationalize its currency, trying to get more trade to be invoiced in the RMB, and it has been successful in some respects. But like we mentioned, getting oil priced in the RMB could be kind of a very critical catalyst to the next step. And so what we argue in our recent research is that this conflict, or the legacy of the conflict, could be the ways in which it starts to erode the dominance of the petrodollar and create the beginnings of the petro-yuan. So there have been some reports that ships may be allowed to navigate the Straits of Hormuz if payments for that oil is made in the RMB. And you can sort of see how that could be the beginnings of a petro-yuan arrangement.
How quickly would any such shift happen? I mean, are we talking years, decades, longer?
So what we argue in our note is that the world could be moving towards more fractured pricing of oil. It's not necessary that we have a full-fledged transition, away from dollar pricing into RMB pricing. What we imagine, what one can imagine, is that while U.S. or Western hemispheric oil may continue to be priced in dollars, oil from Canada, Mexico, Latin America, the U.S., which is a very significant portion of global oil production. While that may continue to be priced in dollars, the potential after this conflict that some Middle East oil that's heading towards Asia could start to move into RMB, it could be a significant kind of implication. And if, like we argued, if oil pricing starts to be priced in different currencies, then trade could start to be priced in different currencies, and savings could start to be built in different currencies. And that's where we move into a world where reserve currency status becomes a bit more multipolar.
But does the US not have almost an inbuilt defense against that, given its shale production, given that it's a big exporter of LNG, if not the biggest exporter of LNG in the world, that actually even if the world priced oil in currencies other than dollars, there is still a lot of energy the world would buy that is still priced in dollars.
No, absolutely. The US is the world's biggest oil producer. It is not, however, the world's biggest oil exporter. So a lot of global oil that is traded is still coming out of the Middle East. A lot of the oil that the US produces is consumed domestically. Now, obviously, this is a big strategic advantage for the US, and we talk about that in the note, that the US is one of the only major economic regions in the world that really is truly energy independent. And that could be worth some safe haven premium for the dollar. And so while the US no longer needs oil from the rest of the world, it does need global oil to be priced in dollars. And one risk out of this conflict is that some parts of global oil could shift away from the dollar.
But the status as the reserve currency, we've seen that sort of underlined in this conflict, which, let's not forget, was, very much driven by the US itself, by President Trump. And yet we still see in times of crisis, the dollar is where people flee to.
So it's fair to say that, if we look at price action in currencies since the start of the conflict, the dollar has gone up, along with other energy producers. But another currency that has been extremely stable in this conflict has also been the RMB. And what we explore in the note is it's not just the ways in which the pricing of oil might move away from the dollar into the RMB, but also how the world might move away from oil itself. And China stands to benefit if that does happen. So if you have a big oil shock, that could get the world thinking about whether it wants to be as reliant on globally traded oil as it currently is.
Do you think China actually wants the RMB to be the global reserve currency, though? I mean, it controls the level at which the RMB trades really, really tightly. I mean, the world would need to be flooded with RMB liquidity as well.
So I think when we think about what is a reserve currency is a currency that the world saves in. And the more the world saves in your currency, the cheaper it is for the government to fund itself, the cheaper it is for companies that fund off the sovereign benchmark to fund itself. So I think being a reserve currency is something that many countries, many major economic regions would aspire towards. And it's something that the US has really secured for itself over the last 80 years.
Malika, while we've got you, you wrote a really interesting note last year about the global south, which I thought was a fascinating primer for investors about, the sort of concept of the global south. Does the thesis that you outlined in that remain intact after recent events?
So I think what recent events are telling us is that the global financial architecture of this world can be influenced by many countries. And really, the contention in our recent research is that the Gulf, countries like Saudi Arabia, which we identified in the Global South piece as being critically important, they could play a very, very big role in the future of the dollar. And so absolutely, I think we are moving into a world where the Global South has more economic power, more economic clout, and can influence the direction of currency markets in the long term.
Okay, Malika, thank you very much for coming in to talk to us about all of that. Malika Sachdeva, the FX strategist at Deutsche Bank Research Institute. Still to come on the show, Warren Buffett speaks to CNBC saying he will deploy cash when the next big market decline takes place. Plus, Apple turns golden as it celebrates its 50th birthday, concluding its global celebrations at its HQ in California. And we'll dig into the latest travel trends from where to go and how to book with Omio Group founder and CEO Naren Sham. That conversation coming up shortly at 7:30 London time.
Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick, and here's the CEO of Siemens Energy, Christian Bruch.
Business leaders should not stay quiet in a world which is super complex. We sit in a privileged position, and we have to use that to ensure that a society remains prosperous, stable, successful.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this.
welcome back. First day of the second quarter of the year, but what a session it was on Wall Street last night. All of the main US indices finishing sharply higher on the session. You can see on the screen there the moves in particular. Stocks might have ended the quarter on a high note, but it was a rough month if you're in the markets. Both the S&P 500 and the Nasdaq saw their worst monthly performance in a year, with all major indices posting their worst quarterly performance in nearly 4 years. 10 of 11 sectors this month were negative, led by industrials. The only positive session, unsurprisingly, was energy. That was up 10% for its fifth straight positive month. Year to date, the sector has gained close to 40%. Exxon, Chevron, ConocoPhillips and Occidental Petroleum were all up by double digits over the course of the month. On the downside, the worst performing sector of the month in March was industrials, down 8.5% for its worst monthly performance since September 2022. And for the year, it was financials, up around 10% so far this year and posting its first negative quarter in 7.
Well, it wasn't just equities that have been on the move. Gold had its worst month since 2013. Surprising to some, given that often at times of conflict and uncertainty, gold is seen as a safe haven. But it's important to look at the other movements that we've seen, and the gold price falling largely in response to the spike in oil prices. Remember, oil prices jumped by about 60% since the Iran conflict began. That fueled concerns around inflation, leading to bets that central banks could potentially raise interest rates. That in turn would make government bonds more attractive, with potentially higher yields on those. And of course, the precious metal, a non-yielding asset, becomes less attractive. Also, some analysts and commentators saying that in some cases where equity losses were becoming apparent for some portfolios, they were in a position of having to sell gold in order to meet margin calls and cover some of those losses. So we have seen a rather sharp fall for gold. Remember, it hit its all-time high, intraday high of 5,626 at the end of January. Same day, January 29th, it hit its record settle, which was at 5,354. So down significantly. It actually settled yesterday up more than 2.5%, but below the $5,000 mark. And you can see there where it's sitting at the moment, 4,700. Let's have a look at the situation for silver. And it too had a rather torrid month, closing March at its worst performance for a month since 2011. Silver's been incredibly volatile. We have seen it soar over the past year, some saying that was down to it becoming a bit of a meme trade and investors piling in and then seeking to take profits from it. Unlike gold, of course, it has a huge number of industrial uses and properties, very much in the tech space. So seeing it give up some ground since the Iran war, perhaps reflecting concerns around the impact on economic growth as well. Meanwhile, in the crypto space, Bitcoin had its first back-to-back quarterly losses since the second quarter of 2022. You can see there down significantly from the record highs it hit last October, when it was in excess of $125,000. It fell at the start of the year, recovering some of that ground, but down on the month. Yesterday, CNBC's Becky Quick spoke to Warren Buffett, no less, asking him if he was waiting for the next big drop to happen before deploying any more cash.
If there is a big decline, we will deploy. But we will deploy it because stocks are attractive or businesses are attractive to us. And we are not planning to sell them next week or next month, so we want to be right on them.
Well, so as we were saying, we have seen the markets give up some ground this month. We're into April now, aren't we? Last month. Have to get used to that, don't we? But what was interesting is some analysts, Ian, talking about the fact that actually corrections of 10% or so are par for the course. This is nothing out of the ordinary, especially put in the context of the biggest geopolitical conflict that we have seen in many, many years.
Yeah, absolutely. And Warren Buffett actually made that point in his interview with Becky Quick. I mean, the point is you have to ride out some of these these sort of storms. I thought what was interesting about Buffett, I mean, Berkshire Hathaway is sitting on this colossal cash pile, some $370 odd billion. I mean, it's obviously now no longer down to him the extent to which they deploy that. But Buffett's always been quite interesting in the past. Whenever equity markets have sold off, he always likened it to hamburgers. He said, if you like burgers and the price of them falls, you want to buy more of them. I think people just have to certainly retail investors just have to sit this out, tough it out, and wait for better things to come. I mean, it's the way that markets, particularly equities, are switching around now on these sort of comments that Trump makes, and they're so kind of impulsive and unpredictable. It's a trader's market. It's not an investor's market right now.
Yeah, and I think what we're seeing there is also the shifting in terms of approaches to where the safe havens are. And I mean, if people had perceived gold as a safe haven and piled into that, they would have taken that trade in absolutely the wrong direction. But we have seen the dollar strengthen. And I think that was very much linked to those inflation fears and the concerns around whether we could see rates either being held or even hiked. But since then, the picture becomes a lot more clouded, doesn't it? Those bets, those expectations seem to have been pared back. There's now renewed talk of central banks even potentially still going ahead with cuts and looking through the energy price spike in terms of their inflationary expectations.
Yeah, I mean that's the big story for me of the first quarter. You expect gold to be a safe haven. You expect U.S. Treasuries to be a safe haven. You've seen a big spike in, for example, 10-year Treasury yields. So perhaps that system isn't working the way it was. Dollar perked up slightly, but not a great deal over the first quarter.